Okay, folks. Selling now is like bolting the barn after the horse is left, right? Okay, couple of things before we start. One is when I get into the classroom before you do, I have to go through this checklist to make sure I've got every item checked off. So I have to come in here. I have to log into my NYU account. Otherwise, I can't get to my H drive. And that requires you go through the two-stage process, which means if I forget my phone, I'm screwed, right? I have to go back up. Uh, Second, I've got to stay the Zoom going, so that requires another set of, don't ask me why NYU asks you again, are you really you? I say I'm me, and then it lets me in. Then once I open the Zoom, I have to hit the record button because that's how you get the recording. So first I want to make sure that all of this stuff is actually working in practice. Because I did put up the links to the class from Zoom, and I put up the downloadable video and audio of Wednesday's lecture, as well as a YouTube version of the lecture. Has anybody tried those links? Do they work? Has anybody tried the links and they don't work? Okay. One thing this might be a little tricky, but if you're not from Stern, how many of you are not Stern students? Okay. You might find that you might not be getting the emails. I don't know whether you are, but if you're not getting the emails, it's usually because the emails I don't put in a list of email addresses. It goes to an alias that's maintained by the school with Google Groups, which is connected to your Albert, and the two don't talk to each other very well. And if you have an NYU email address, it sometimes can't find you. So today after the class, when you get the email, I'll send you a link on how, if you're a non-Stern student, you can get that Stern email address, which is actually assigned to you the minute you got into class. And you will need it for other stuff that you access at Stern. So Brian came up before the class and he asked about the big question that should be all on all of your minds. Today was an interesting day, right? And I'm using the word interesting the way the Chinese use it in a curse, which is may you live in interesting times. It's not a good thing. You know, we all want to actually live in boring times. Interesting is not always upside. There's a lot of downside. And what happened over the weekend that's kind of upended at least portions of the world? Yeah. So DeepSeek came out. So what's different about DeepSeek as opposed to all this AI stuff keeps coming out? What? Okay. Friday, if I told the company I was going to value tomorrow is going to be Nvidia. I've decided to put it off for a week because I'm in a little bit of turmoil and I haven't had a chance to revisit the Nvidia story. So why would the Nvidia story change because of something that happened over a weekend? On Friday, the story I'd have told for Nvidia is it makes these AI chips that are incredibly powerful, without which you can't build AI systems. And to the extent that you believe AI is going to be this big business, Nvidia is an integral part. So the entire valuation is built on that premise of how big will the AI market get? How much will people spend on chips? And Nvidia will be the dominant player in that chip. And DeepSeek basically upended that story, right? Basically, it said, look, I mean, it might still be true that and I think this is still going to be true, that for a portion of AI, you will need the NVIDIA chips. For your grocery store, trying to figure out what people are going to buy off your shelves, might not need high-tech AI. You might be able to get, and let's face it, a lot of the AI products and solutions are trivial products and solutions. And DeepSeek says, you know what, you can get by with the chips you have. Not the potato chips in here, but you know what I'm talking about, the Intel chips, the AMD chips. This strikes at the heart of the NVIDIA story, right? Because the minute this comes into the story, it means that your potential market becomes less than what you thought it was, even if you thought AI was going to be successful. The market gets smaller, that is going to have ripple effect. We talked about stories and numbers. The story had a fundamental shift today. Doesn't mean you can't tell a new story and a new value, but you got to be okay with that. This can happen to your company, right? You can value the company and somewhere in the middle of the semester, something can happen. So, oh my God, Hopefully, it won't be the end of your company. 23andMe, and somebody hacks into the computer, steals all the genetic stuff. The company's dead. That's a story break. This is a story change. Is Nvidia worth less today than it was 3 days ago? Yeah, absolutely. Is it priced less today than it was 3 days ago? Absolutely. In fact, today, Nvidia lost how much of market cap? Do you know? About $800 billion. It lost the equivalent of the entire African equity market or the entire Middle Eastern equity market in one day, if you don't count Aramco. That's a big loss. So what's the question we're asking in valuation? We agree, both sides agree that the number attached to NVIDIA should stop. The question I'm going to ask in the next week, and this is going to be my next week's assignment, is, hey, given what this has done to my story, what is NVIDIA worth now? And what I'm looking for is the value drop by 800 billion, a trillion, 600 billion, 400, because if it dropped by only 400 billion, the market's down 800 billion. This might be actually a good time to buy. It's a good time to ask the question. But that's going to be my exercise starting tomorrow. I did promise you a valuation of the week. So you're saying, what are we going to value this week? You're going to answer the question. The one question I absolutely hate to be asked on CNBC, but I will get asked every single time. Every time I go on, you know what what I get asked, right? What do you think about the market? Do you think it's in a bubble? I'm going to give you my answer to that question at the start of this year in a valuation of the S&P 500. I'm going to do an intrinsic valuation of the index. I'm going to give you my finding on it. My keyword is my. And you're going to take my spreadsheet. I've done the dirty work for you and disagree with me. Say, I don't like your growth rate. I don't like this. I don't do whatever you feel comfortable doing, but use the Google shared spreadsheet to enter what you discovered to be the value of the index. Let's start big, right? This will make you the most sought after, the least sought after person at your Thanksgiving dinner. Most sought after, if everybody says, what do you think the market will do? Now you can say, give some deep thoughts. Okay? Least sought after because nobody wants to talk about the market. They want to talk about the turkey. That too is okay. Right? So that's going to be the valuation of the week. But trust me, next week, you're getting NVIDIA. And let's look at the ripple effects. NVIDIA is directly in the target zone, right? Chips. You don't need the chips. What else has been affected? What else, what else goes in the AI architecture in addition to chips? Well, that's, I think, peripheral still, because those are products. Power, because the story with AI is you need these incredibly power-hungry data centers. And there's a company called Constellation Energy. Take a look at it. And what does it do? Its value's gone up in the last couple of years because it provides the power to these data centers. It's been slammed to death. Think of this. So if you think in terms of concentric circles, the immediate effect is going to be on the AI architecture companies. Why? Because all those... The next layer is going to be on the companies that have spent money in the architecture, mostly big tech companies. Half of the money spent on AI chips came from the big tech companies. They were spending on AI chips. Why? Because they hope and pray. None of them is making money on actually AI products and solutions, but because they think the market is big, they've spent the money. And now they're probably looking back at, remember last week, Satya Nadella was asked how much he spent on AI, and he said 80 billion, and I'm okay with that. He might not be okay with that today, but you're not going to get the money back. The good news, if you're a Microsoft stockholder, is, hey, you can afford to lose 80 billion, not even notice the difference, right? They have 150 billion. It's not going to break or make or break, but there's going to be some, buyer's remorse. So he said, look, we shouldn't have done that, which will be lead. But there's another effect that I think people haven't thought through. This whole game is about providing AI products and solutions. And I think DeepSeek has now made that reach even greater. More of us are going to be able to get these, but it comes with a catch. There'll be less money in this business because it's going to be easy to provide these products and solutions. The old game was, hey, if we're Meta, you're AWS, you're going to spend the money on AI chips, and then you will have the special product that you and only you can deliver, and you're going to charge a premium price. That's going to be much more difficult now. So in a strange way, DeepSeek has opened up the AI business. We're far more likely to see AI products and services as consumers, but it might have commoditized the business at the same time, which means there's a lot less money to be made. Has everything been adjusted? No, right now it's the start of the process. The markets are just confused, right? They're just selling whatever they're told to sell. But this is the time to think about value. We'll talk about value in the face of uncertainty. So pick Constellation Energy, pick Amazon, and that's going to be the exercise I go through. Is I'm going to start with Nvidia, the direct hits, and then we'll go in concentric circles and then ask the bigger question: what does this mean for AI as a business going forward? It's going to be a bigger business, but a less monetizable one. So I'm going to let that roll. I'm going to take a long walk without my iPhone, let that roll around and see what that plays out. But that'll come next week. But you don't have to wait for me to come up with it. You can start thinking about it because there are these ripple effects that are going to play out. Today, I want to start with your project. I kind of talked about it. But before I talk about the project, I first want to say, talk in terms of what goes into your grading. Here's what will not go into your grading. I don't take attendance. There's no participation trophies, so I don't add points for participation. So I want you to participate, but for the right reasons. Do it because you feel you have, you have a question to ask. Your grade will be based on 3 quizzes and a final exam. The 3 quizzes are each worth 10% apiece. The final exam is 30%. The quiz dates are in your syllabus, so you can check out the dates. You're saying, what if I cannot make a quiz? I have an interview. I know life gets in the way. If you do miss a quiz, here's what's going to happen. The 10% on that quiz will get moved to the remaining quizzes and the final exam. Let me repeat that again, because I know even though I'm saying this now, I will get an email every week for the name. What happens if I miss a quiz? Here's what happens. If you miss the first quiz, that 10% will be proportionally allocated, which means your second quiz will now be worth 12%, the third quiz will be worth 12, and the final will be worth 36. If you miss the second quiz, that 10% will go into the third quiz. You're saying, why this convoluted exercise? Because I've been teaching 40 years and I've seen how you guys game the system. You know why I don't let you kind of reweight everything, right? Because you get strategic quiz missing then. You do really well in the first 2 quizzes, you're going to be tempted to miss the third quiz. Why? Because it makes your first 2 quizzes weighted more. Not with me. It's always going to be the future. So it's okay to miss a quiz. If you take all 3 quizzes, there's a bonus I will offer you, which is I will take your worst quiz and I will throw it out and reweight the other quizzes. Actually, I won't throw it out. I'll give your worst quiz the same average score you got on the other 2 quizzes. So let's take an extreme example. You get 10 on quiz 1, you get 0 on quiz 2, and you go back to doing 10. What happened? You're bipolar, and that was your bad time, and the 0 was when the bad part hit. Here's what I'm going to do. I am going to take your 0 and replace it with a 10. Why? Because you got 10 on the other 2 quizzes. And I'll bring in also your final exam. So basically, I'm going to give you an escape hatch on 1 bad quiz. Okay? Don't ask me what happens if you have 2 bad quizzes. You can work out the math. The escape hatch gets smaller and smaller. If you had 3 bad quizzes, it got really tiny, and you're an elephant trying to get through a mouse hole, and I'll let you figure out what to do next. Okay? The quizzes are open book, open notes, and open iPad displays. And the reason is very simple. It's open book, open notes. My notes are probably all on some digital device for you, right? Most of you haven't printed it. So if you have an iPad, a computer with the slides, if you want to look at it, fine. But you cannot open up Excel on your laptop, not because you're going to get an advantage, but because you have 200 people with laptops open to Excel. God only knows what will happen in that room, and bad things happen. So it's open book, open notes, open device to get to your slides. And I will write the problems in such a way it's not convoluted that you need an Excel spreadsheet. So none of the problems will test you on can you project things out for the next 10 years. It'll be built around doing numbers in your head. So this is really about testing you on whether you can apply the concepts you do in class. So those are the 3 quizzes. What's on the final? Everything. Now it'll cover the entire class, which is a lot. But by then, you've already got 3 quizzes. You can, in a sense, at least build on what you've learned. So if you miss a quiz, my advice is take the material you missed in that quiz and get up to speed on that, because eventually you will need it. You're saying, what about the other 40%? It's for your project. And That's what I want to spend a few minutes on. The project is basically a group project. So you're saying, who should be in your group? You pick your group. I'm not putting you in a group because that way you will come to me and say, I don't like the group you put me in. You live with the group you pick. You self-police the group. What does that mean? Every group has a few people who kind of lag. You figure out how to get them online because in a sense, you get a collective grade. So that's a lot of responsibility, is saying, but this is the way the business world works. You're often carrying people on the group. Now you figure out a way to get their attention, make them watch The Godfather, especially the scene where the horse's head gets cut and put on the, no, essentially say bad things are coming at you if you don't keep up. But I'll let you figure out what those bad things will be, right? So you pick your group. The group can be up to 8 people. And you don't need to meet very often, but with 8 people, you're carrying a lot more people, right? So you got to make the trade-off. Do I want to go? Your group has to be at least 4 up to 8. So what you decide to do, again, I will leave the choice to you. And here's what you're going to do. Each of you is going to pick a company to value. You can pick whatever company you want, public or private. If it's a private business, just make sure you can get the financials for that business. If it's a family business, make sure you're still talking to your family. If not, your family business is going to be tough to value. And make sure you're going to continue to talk to your family after you value the business. So all those things have to be juggled in there. But if it's a private business, that's fine too. But I will impose an overarching group constraint, and I'll come back to what I mean by, which is when you pick your companies as a group, at least one of your companies has to be a money-losing company. I want you to face the pain of dealing with losses and what to do about them, because there's no escape hatch, right? Easy escape hatch in terms of just increase the profits, everything's going to be okay. If you have losses, you got to figure it out. At least one, and that money-losing company can be a young startup, it can be a declining company, either. And I'm going to define money-losing as this company had negative operating income in the most recent year. Not net income, negative operating income. Okay? At least one of your companies has to have high growth potential. Hope more in revenues than in earnings. So you're picking a business in some growth business. I'm not going to put some artificial number like 25%. Just pick a growth company. You'll know it when you see it. Third, at least one of these companies has to be a non-US company. And I'd like you to value the company in the local currency. So you want to pick a Brazilian company, for God's sakes, value it in reais. And if you want to value it in dollars, give me a really good reason. Why? Because I want you to get comfortable working with different currencies. And finally, at least one of these companies will be a service company. That's an easy one to meet because 90% of companies out there provide services. Now notice, your group has to meet these constraints. Can you have one company that meets all these constraints? Yeah, you can find one money-losing foreign company which meets 3 of. You think, why would I do that? This is your punishment on that 5th person who wants to join your group. Say, we're all going to value nice money-making mature companies. You get the money-losing high-growth foreign company and let them carry the burden. But I'll give you, if you really want to understand valuation, you're going to learn more about valuation dealing with these difficult companies than with the easy ones. So that's my only constraint. My other piece of advice with the project is don't wait too long. You know what I mean by wait too long? Don't go like Hamlet, I don't like that company, I'll try it not. So it's week 5 and you still have picked a company. It's getting late in the game. Pick a company, and if you want to change your mind, you're perfectly okay changing your mind. There's a master list that I will send you where once you've told me you're in a group, I also ask you a company, so go enter the company in the master list. I want to see the company so I'm aware of what's being valued in the class. And again, if you want to change your mind, change the company, I'm okay with that. So make sure you visit the master list, tell me whether you're in a group, and pick a company and try to do it as soon as you can. You're going to be doing a valuation of the company. And that valuation, I'm going to give you a one-time freebie, which is midway through the semester. I think the actual date is, I don't know why it's clicking through. Okay. On March 29th, you can send in your intrinsic valuation, which might just be a spreadsheet. It's a one-time deal because I will check through that spreadsheet and not tell you whether the valuation is right. Don't have that power, but I can tell you whether there's an internal inconsistency, whether glitches you need to fix. It's completely optional. So if you feel completely comfortable saying, I know what I need to know and I'm going to do it and turn in the final valuation on May 5th, it's your valuation. But if you want to take advantage of that mid-semester feedback, the entire project is due on May 5th, the last day of class before 5 p.m. that day. Any questions on the project? Yes, go ahead. Yeah. Did everybody get the question? Let's say he picks Netflix. Can somebody else pick Netflix? So don't look through the list. It doesn't matter. Last semester, I had 11 people valuing Netflix, 7 people valuing Spotify, 5 people, I think, value. Basically, I can tell what you do in your spare time by the kind of companies you pick to value. DraftKings, Netflix, Krispy Kreme used to be a very big favorite. You know, basically, you haven't picked a company. You're sitting there eating a Krispy Kreme and watching Netflix, and I have to pick a company. Look at the box, Krispy Kreme. That's a good enough company. Okay. So I have, it's perfectly okay. You know why it's perfectly okay? You think 7 people valuing Netflix come up with the same value? There's 0 chance of that happening. So you can pick the same company. You're going to tell different stories. And at the end, you're going to see the differences and you can see why the differences happen. Yes. It's an interesting question. What makes for a non-US company? The easy answer is it's incorporated, traded, does its business. So is Alibaba, Alibaba for until very recently was a US traded company, right? It was traded in the NASDAQ, incorporated in the Cayman Islands, but it's a Chinese company. So cut to the heart of where the company is. It might be incorporated and traded in a strange place, but that'll determine the non-US company. So if you want to pick a Chinese company that is listed on the NASDAQ, for whatever reason it might be, corporate governance reasons, capital raising reasons, it's still a Chinese company. Any other questions? Yes. God help you with a Russian company. I'm sorry. I'm sorry. I no, and I'll tell you what the biggest challenge is going to be. When you value shares in a publicly traded company, what are you implicitly doing in intrinsic valuation? You're acting like you're part owner of the company, right? And already there, a Russian company, things get shaky. I'll tell you, and this is personal pain coming through. I used to own shares in a company called Lukoil. I thought I owned shares in a company called Lukoil. Let me preface. It's a Russian oil company. Actually, it's a company that I liked, right? I wanted to get an oil company in a part of the world where people don't really throw it. It was trading at what I thought was it was an undervalued company, and it did really well for me until one day, it just disappeared from my portfolio. It went to 0 overnight. Do you know what happened? Russia invaded Ukraine, and the stock I bought is actually not on the Russian exchange. It was on the London exchange because it was. I said, "This is good. I buy it on an exchange that I'm comfortable with." And then the sanctions get imposed, and the London exchange essentially disappears. Value 0. I call my broker and I said, "What the heck do I do now?" It says 0. He said, "Well, you can't get money back on the London exchange, but if you really want to lay a claim, there's a pathway." And I said, "What's the pathway?" He said, "You should fly to Russia and lay claim on your shares." And I said, "Will I come back?" And they said, "No." And so it's at 0. I'm not planning to get it back. The problem with Russian companies will be, are you Russian? So you feel comfortable about your ownership stake in the company you're going to value? Okay, that's fine. So if you want to value Russian company that you feel comfortable that your shares actually lay claim on the, because I don't think it's a problem actually putting a value on a Lukoil or a Severstal because they're steel company, oil company. It's when you get from that value to value per share that you're going to run into these issues. But if you feel comfortable enough, I'm perfectly okay. In fact, I would love to see a Russian company actually valued. It doesn't matter because what are you going to do? It's not the value that I'm looking for. The final part of this project, after you value the company and you've priced it, is you're going to compare those numbers to the market price. Right? As long as they're in dollars, you do everything in dollars. If you want to do everything in rubles, do it in rubles. You're not making recommendations to me. You're making recommendations for yourself to decide whether to buy or sell. That's the end game for the project. Is keep that in mind. This is not an exercise in coming up with a number. It's an exercise in coming up with a number that you can act on. Okay? So that's going to be the final part. You're going to value the company, then you're going to price it, and then you're going to put out a recommendation, which is buy or sell. Don't weasel out. Don't give me weak buy, weak sell, semi-strong buy. You either buy or sell, right? So I'm not going to let you get all those layers of, I don't feel like doing it, so I'm just going to say weak buy. So take it. I will let you hold in extreme cases, but I will call you a chicken when you do that. So be ready for that. But that's going to be the end game for the project. Okay? Yes. Somebody back there had a question or just, okay. Any other questions on the group? Yes. They're subjective for the project. The quizzes and finals, it's entirely objective. They're subjective in the sense if you do everything I ask of you, you're probably putting a floor on your grade. The floor would be a decent one, B, B plus. So basically, if you just go check, 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 you've done everything. You think, how do I get an A? Well, show me your creative, show me a story, show me something that, that the numbers couldn't have done. The way to think about it, think of a bot looking over your shoulder with your name on it. A bot that actually can look at spreadsheets, fill in numbers just based on mechanics. Ask yourself, what can I do that a bot can't do? That's what I'm looking for. In fact, if any of you want to get ChatGPT to value a company, combine that with your valuation because ChatGPT will do all the mechanical stuff right. And then say, this is what I'm seeing in the story that ChatGPT did not. So have no qualms about using AI to do an evaluation because this is about you saying, what do I bring to the process? Because that's what the real world is going to look like when you get out there, right? So use whatever tools you want, but show me that those tools matter. Any other questions on the project? Okay, go ahead. You're thinking way ahead. Pick a company first, worry about delivery. It will get done. I've taught this class for 38 years. It always gets done. You say, I can never value, trust me. I will drag you across the finish line if that's what I have to do. By the end of this class, you will have valued the company you picked and priced the company. Some of you might have gone through incredible torture to get there, but you will get there. That's my job. So the deliverables, if you go on, you'll see past projects so you can see what they look like, but you'll notice that the format is all over the place because I give people freedom in how they present it. My only rule is keep it short. You know why? You've got to read all your projects. Now, I grade all my stuff, exams, quizzes, and projects. And if you write 40-page projects, I am completely and totally screwed. So there will be a page limit. I don't want you to write a creative novel. Just do the damn assignment, which is value the company, price the company, tell me whether you'd buy or sell. That shouldn't take you 50 pages. If you're lucky, it might take you 5 pages or 6 pages. Yeah. So keep it short because, and I will put a page limit precisely for that reason. So let's talk about valuation. This is the first set of slides. If you didn't bring them, don't worry. It's the intro pack. Let's talk about valuation. So what I'd like to do in today's class is first start with a very simple explanation for why I do valuation. Let me start with the preface. Most people who do valuation don't believe in valuation. Include most people, bankers, analysts, appraisers. You think, but they do valuation. They do it because it's their job. But if you ask them in an honest moment, why is Nvidia trading at $105 per share? Why did the price drop by 800 billion? Their answer is because that's what the market thought should happen. If I believed that, I couldn't teach this class. So I'm going to start by explaining why I teach valuation. I teach valuation to fight the lemming in me. Heard of lemmings? Lemmings became famous or infamous in the 1950s when either National Geographic or Disney, the parentage is kind of hazy as to who did this, filmed the most amazing sight. Thousands of big, ugly, rat-like creatures gathered together on a cliff, ran right off the cliff into an ocean, and committed collective suicide. And ever since, one of the big questions is, why did they do it? What led them off? I don't know the answer to that question, but let's do some virtual imagery. Let's say you were the first lemming. Cliff comes up, you didn't know it was coming. You go off the cliff, you go into the ocean. Incidentally, these guys can't swim. That kind of seals the deal. Dead. Second lemming, too close to the first guy, also slides off the cliff, also in the ocean, also dead. But I'd like you to put yourself in the shoes of the very last lemming. I know lemmings don't wear shoes, but kind of hang in there with the analogy. You ready? You're running as fast as you can towards a cliff. You've seen your entire tribe disappear off that cliff. I would think you'd have second thoughts about what you were just planning to do. Your left brain, right brain, whatever part's rational says, stop, 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 don't do it. And then you hear this voice in the back of your head. You know what it's saying? They must know something that you don't. Remember those 7 words in investing in valuation. They must know something that you don't. So let's say you value Nvidia. You beat me to the punch. You value it this way. You come up with a value of $130 per share. The stock is down to what, 110, 115? What's your rational side saying? You should buy the stock now, right? But then you hear this voice in the back of your head. They must know something that you don't. Why? All those people selling the shares must know something that you don't. And when you hear that voice, magical things will start to happen to your valuation. You'll bring down the growth rates, increase the discount rate. 130 will become 120, become 115. You're with everybody else. Don't fight it. There's a lemming inside each and every one of you dying to get out. Just let it out. You can divide the whole world of investors into 3 groups of lemmings. The first group, I call proud lemmings. I'm a lemming and I'm proud to be a lemming. They call themselves momentum investors, but that's what they do, right? You know what momentum investors do? They look for a crowd, they join in. You're buying, I'm buying too. You're selling, I'm selling too. Lots of proud lemmings today selling Nvidia. Why they're selling? Because everybody else was selling. It wasn't that they thought through what DeepSeek would do to earnings and cash flows. They were just heading for the exit because they see everybody else heading. Amazing amount of investing is momentum investing. I can't pull off being a proud lemming. The second group I call Yogi Bear lemmings. Now, you've heard of the legend of Yogi Bear, lived in Yellowstone Park, I think, was smarter than the average bear. Yogi Bear lemmings think they're smarter than the average lemming. You know what they want to do? They want to run with the crowd till the very edge of the cliff and last moment veer away. Admit it, you're tempted. You get all the upside of momentum, but you'd have sold Nvidia on Friday because you saw the cliff coming. You watch CNBC, you'd think there are a lot of Yogi Bear lemmings out there, right? They all, especially after a market correction, they all get on and they say, I saw that coming. You were on every week for the last 6 months. How come you never mentioned it? Maybe it's because you didn't see it coming. I'll make a confession. I have no idea where the cliff was coming. I didn't see this weekend coming on Nvidia. I would be lying if I said otherwise. I can't pull off being a Yogi Bear lemming. So if you ask me to describe myself, that's me. A lemming with a life vest. That's all I aspire to be. Let's face it, we're all human beings. We're going to get caught up in the mood at the moment. If everybody's upbeat, you want to buy. If everybody's downbeat, you're selling. You can't fight. All that valuation does is slow the process down for me. The reason I'm valuing Nvidia is to slow the process, is to see if my rational side can mount an argument. Because my human side is saying, sell everything, head for the trench, head for the exits right now. Everybody else is doing it. So what's the end game for this class? I hope to throw you that life vest. That's what I hope you get out of the class. A life vest that you can hold on to, that outclass that crowd behavior, because you're going to buy stocks, the crowd is going to change its mind, and you're going to feel the urge to run with them. And maybe this process will slow you down so that you can do the right thing. So with that set in place, let's talk about 3 misconceptions about valuation that I think cut to the heart of almost everything that goes wrong in valuation. The first is that evaluation is an objective search for the truth, that you're some kind of scientist sitting there valuing companies. You know what feeds into this? Big numerical models and computers. You sit in front of the computer, you start entering numbers. I'm being objective. I'm just entering numbers. That's an absolute lie. Every valuation is biased. You know why? Because when you walk in to value a company, you're already coming in with preconceptions about that company. And those preconceptions are going to find a way into your numbers. Let me give you a very personal example. I have valued Microsoft every year since 1986, since their IPO. For the first 28 years of their existence, every time I valued Microsoft, I found it to be overvalued. You name the price, overvalued, overvalued. Strange, right? One of the great success stories of the late 20th century. I wouldn't have bought it one step of the way. I could give you access to every single valuation I've done of Microsoft. And you could dig through the numbers looking for clues, but you'd be looking in the wrong place. If you really want to know why I found Microsoft to be overvalued, all you need to do is go out of that door, take the elevator up to the 9th floor, walk to my office, the door's open, walk in, don't take any of the stuff in there, and look around. You know what you're going to see? You're going to see my MacBook Pro. My iPhone is with me. My iPad is right next to my MacBook Pro. I don't know whether I bought my AirPods out or not, but they might be sitting there. I have an Apple display. And if you look towards the top shelf, I have my original Mac 128K that I bought in the 1980s. I've been an Apple user since 1981. And to me, Microsoft has always been the Darth Vader of technology. Now, if you're a Star Wars fan, let me be specific about which Darth Vader I'm talking about. I'm not talking episodes 1, 2, 3, Anakin Skywalker, cute boy, Darth Vader. I'm talking episodes 4, 5, 6. He's dressed always in black with I don't think he ever takes a shower. He has a strange voice. I have lots of bad thoughts about Bill Gates, and they all come, and nothing to do with vaccines. I have just bad thoughts about Bill Gates that predate vaccines. And they all come bubbling up to the surface when I sit down to value Microsoft. And guess what? When I'm looking to see to give them high growth or low growth, my response is, who'd buy this rotten product, low growth? High risk or low risk? You're one virus away from blowing up, high risk. My biases were so deeply entrenched that I was incapable of valuing Microsoft. And I've given a clue of another company I've always struggled to value, right? Which is Apple. If my trouble with Microsoft is I hate the company too much to value it, my trouble with Apple is I love the company too much to value it. I valued in my blog every year for pretty much every year since 2010. If you go back and read my first blog post on valuing Apple, I spent half the post telling people, don't trust me. I love this company too much. That's all I can do. I can't tell them I'm going to be magically objective and put that all to the side. So all valuations are biased. And the more you know about a company, the more you've read about it, the more biased you're going to get, which is a irony, right? Because what are you told to do? Go research the company, read what other people think, which is all good, but at the same time, your biases are getting entrenched. We follow up on that. You tell me who pays you to do evaluation and how much you get paid. I'll tell you which direction the bias is and how much the bias is. I sent you a test. I don't know whether any of you took a look. I'm going to take you through that test because this is a good time to talk about biases and how they play out. You have no idea what I'm talking about, right? You already stopped reading my emails, so that's fine. No, so let me open up the test because it's a good way to see what these biases translate into. So I have to stop the share and start the share again because otherwise I lose the share. So let's see. So ready? None of what I'm going to ask you is going to be technical, but play along with me because I think it's going to bring home what I mean by biases. First, if you think about where biases come from, right? They come from almost everything you do. The first is the subconscious. Right? When you think about a company, already in your mind, the more you know about a company, or it's a good company, bad company, great company, amazing company. Take a company you're familiar with, Nvidia, Apple, Amazon. Take the Mag 7. You already have some preconceptions, good or bad. That finds its way. Right? There's a lot of herd behavior. Everybody else thinks a company is a great company. It's going to find its way. If Jim Cramer yells out the name of the company, that's why you picked it, and you like Jim Cramer, whether you like it or not, that bias is going to show. The second is the power of suggestion. There's one semester where I actually had an assignment in the middle of the class, which I've taken away, where I gave people an IPO to value. There were two sections of class. So I gave them both the same prospectus, the same IPO. With one group, I said, your job is to assess what pricing you'd set for the IPO, and I left it at that. The other group, I said, your job is to assess the value for this IPO. And by the way, people, I think it's worth about 35. I just wanted to see what would happen by just planting that little seed. So the valuations come back from the IPO. I put up histograms of what people found. The class where I didn't mention 35, the distribution is centered around $20. The class where I threw in the 35, which I completely made up, the valuations all got centered around 35. I tell managing directors this, for God's sakes, when you ask your team to value a company, don't throw a number out there and ask them to ignore it. They're not, it's going to go into your bias. And thirdly, and this is the most powerful bias of all, is the power of money. When you get paid to do a valuation, stop telling me your objective. He who pays the piper calls the tune. In valuation, if you get paid for valuation, it's going to find its way in the bias. And the larger the amount of money that's at play, the more biased you will get. So we're going to do a little exercise to see how bias plays out. So let's say you're an entrepreneur and I'm a VC. So you come to me to raise capital. Everybody familiar how that process works? I raise capital. What do I get in return? When she said, I've never been a VC. You've seen Shark Tank, right? So basically, you're the founder. I'm the VC. I will give you money, and I get a share of your company. So when you value a company for raising capital, is your bias going to be to come up with a higher value or a lower value? Lisa? Higher. Why? Because if you get a higher value, you have to give up less of the company to mark or to one of the other sharks. So think of the other shark sitting. So and how are you going to do that? You might push up your growth rate, make your pretend. But if I'm on the VC on the other side, what's my objective? Is to take a zero off the end, to come up with a lower value. Already you can see bias is going to drive those two valuations. Let's go further. Let's say you're valuing your own business, and this is too soon in your life, but you've become successful, you're 35 years old, you built this great business, and now you want to part ways with your spouse. We won't go into the reasons. But this is going to go to divorce court, and your soon-to-be ex-spouse is going to get half your business. You come to me as an appraiser to value a business. What do you want as a number? Zero, if possible, because half of zero is zero. That way you can go to your ex-spouse and say, my business is worth nothing. I'm a terrible manager. I'm going to run this business into the ground. You're an appraiser for the owner, valuing a business for tax purposes. High number or low number? Do you want to go? You want to pay more in taxes or less in taxes? Let me save you this incredible choice. If you're struggling with that question, you're in the wrong class, right? You can take a economics class about fairness, and you want to fight that bad. This is not the place to fight. Let's face it, you want to get away paying as little in taxes as you can. So you want to make it. Valuations for tax purposes are often absurdly low. And if you're the IRS, you're going to push in the other direction. The only problem is the IRS is too cheap to often hire the best experts, so you have better experts, so you might win in this game. But that's, again, bias. I know some of you are planning. In fact, somebody during the break said they were looking at a sell-side equity research job at Oppenheimer. Is it, person here? No? Let's say you go to work for sell-side equity research. You know how equity research is structured, right? Buy-side equity research is equity research for firms like Fidelity. And the research you do informs how a mutual fund or what stocks it invests in. What do sell-side analysts do? They are given a sector to track and they put buy and sell recommendations. And then people they offer it as a free service. So if you're a sell-side equity research analyst and you're valuing a company to put a recommendation on it, are you biased upwards or downwards, or should there be no bias in this process? Let's say you push up the value. What do? You put a buy recommendation, right? You push down the value, you're going to put a sell recommendation. Which one of those is easier to live with as a sell-side equity research analyst? And tell me why. Why is a buy easier to live with? What's your primary source of special information if you're a sell-side equity research analyst? It's a company, right? I know what walking to that gray line between legal and illegal, but you're trying to get some special information that's not in the price. Minute you put a sell recommendation, guess what happens? All your contacts will come. You know that buy recommendations outnumber sell recommendations 10 to 1. It doesn't surprise me. The bias in that process pushes you to come up with a high number because it makes your life easier as a sell-side analyst. If you're a buy-side analyst and I ask you to value, let's suppose I own 1 million shares of Nvidia. I'm feeling a little shaky today as a portfolio manager. You're my favorite analyst. Say, can you value Nvidia for me right now? And you would. What's the report I hope to get from you? What will make me happy and what's going to make me a little pissed off? I'm sorry? I don't get that. Life is so much easier if I don't have to sell the stock, right? So if you come back and say, you know what, it looks undervalued. So, oh, thank you, God. If you say it's overvalued, you're creating a whole host of issues for me because I now have to sell the stock, explain to my clients why I left the money in the table. Bias comes from the fact that when somebody asks you to value a company, they're not doing it with this completely unbiased perspective. They like a particular answer. They claim that they will be okay with an honest answer. But I'm reminded of that Jack Nicholson line from A Few Good Men. If you want, you should watch the movie. Okay? Because at the end, Jack Nicholson is this general in the army. He's covering up some bad stuff, and court, whoever it is saying, this is the truth. And Jack Nicholson blurts out, you cannot handle the truth. And a lot of people who ask for valuation advice really can't handle the truth. They want an answer that they want to. But if you're a buy-side analyst valuing a company for somebody who shorted the stock, what do they want? They want confirmation again. The world is full of people wanting confirmation. They don't want the truth. They want you to tell them you're right. That finds its way into the bias. Finally, let's look at the M&A process, which in my view is the most screwed up process on the face of the earth. You're an M&A banker working for the acquirer. Remember, there are four players in the room in an M&A. There's the managers of the acquiring company, managers of the target company, banker for the acquiring company, banker for the target company. And there's a friendly merger. So let me ask you right off the top, who in that room doesn't want the deal to go through? First, do the bankers want the deal to go through? Yeah, absolutely, both sides, because that's how you get paid. The manager of the target company might want the deal to go through, but the manager of the acquiring company also, because they want to dress it up and say, this is a great deal. There's nobody in that room who wants to be told that this is not a good deal. Already you can see why so many bad deals go through. There's no pushback because it's other people's money. Remember, the manager of the company are not spending their money. And if you're an M&A banker working for the target company, you have a different challenge. You got to convince your shareholders that they're getting a great deal because you want the deal to go through. It's actually interesting that the bankers on both sides convince their side that they're getting a good deal. How can a deal be a great deal for both sides? I'll let you work it out. But this is why people create magical words like synergy, because that way both sides can claim we're winning. Because in any deal, if you're getting a great deal, I'm probably not getting a very good deal, but somehow that magic works out. In a hostile acquisition, though, the game becomes interesting. The acquiring company wants a deal to go through. The target company wants to stop the deal. So if you're the investment banker for the target company, what do you have to do? You have to show your shareholders that the price being paid is too low, that they should turn down the offer. Again, there's bias. The acquiring company has this tricky path, which is they want to claim that you're paying a higher price, but that you're still getting a good deal. M&A banking is where valuation first principles go to die. There's so much bias in this process. You might as well strangle that valuation in its crib because it doesn't deserve to get out of there. Bias is endemic out there, right? So when you think about but bias in the game, it comes from all over. Incidentally, what you saw there was meant to be the start of the class test, but I wanted to get the project thing. You're going to see at the start of every class, the start of the class quiz. Don't worry, it's not for a grade. And what I'm going to test you on is what we're going to cover in the next 80 minutes. You're saying that is ass backwards. It is meant to be. And my objective with these quizzes is to show you that you already know the answers we're going to come up with intuitively and that the class is just going to fill it out. So first misconception about valuation is bias. In fact, let me tell you a story about how bias plays out in valuation. So about 30 years ago, a company called Lynn Broadcasting, it was then called Lynn Cable. AT&T had this option to buy 49% of Lynn Cable at an appraised value. That's the way the option was written. Time for the option to be exercised comes about. AT&T goes out and hires Morgan Stanley. So you guys are going to be Morgan Stanley. You work for the buyer. What's your job? To assess the value of the 49% so AT&T can pay it. Lynn Broadcasting hired its own investment banker, Lehman Brothers. I'm sorry to do this to you, but think of yourselves as pre-bankrupt Lehman Brothers. And you work for the seller, and your job is to assess the value of the 49% so Lynn can sell it. So Morgan Stanley works for the buyer, Lehman Brothers works for the seller. One bank comes back with $105 per share. The other comes back with $155 per share. I want you to guess which one came back with 105 and which one came back with 155. You guys be the guessers. Who came back with the 105, you think? Yeah. And why? They work for the buyer. Your job is to get the low ball number. It's not that they're doing a bad job or they're not virtuous people. They did their job and Lehman Brothers did their job. In fact, the difference was so large, they decided to call in a third investment banker. Why settle for 2 fees when you can have 3, I guess? And they called this outfit called Wasserstein Perella. I'm going to say something incredibly harsh about these guys, but I mean every word of it. These guys couldn't value a $20 bill in a brown paper bag if you put it in front of them. They didn't invent some multiple enterprise value to cash in the bag. Next thing, you'd be paying $66 for a $20 bill. But if you're Wasserstein Perella, you're right in the middle here, right? You don't want to piss off either side too much. You got to work with both sides in the future. 105, 155. Where's the safest place for you to be? 130. They came back with $127.50. I'm going to let you in on a little secret in valuation that you shouldn't let out of this room. If you're ever asked to value something, never ever come back with a nice round number. Don't tell me the target price is 40. Tell me it's $38.87. It's amazing what that second decimal will do in terms of creating an illusion that you actually know more than you do. The intimidation factor kicks in. In most valuations, the value gets set first, the valuation follows. People decide how much to pay and they look for justification. In my view, in M&A banking, you shouldn't even value companies. You know what the value of a target company is? It's whatever you've chosen to pay plus $10. Why do we torture young analysts and make them run through spreadsheets for 2 weeks to arrive at that conclusion? Because that's exactly where you're going to be. Those number crunchers, you're going to come back with a number, and the managing director says, that looks a little low. Can you run the numbers again? There's an implicit message. Don't run it with the same inputs. Try changing them. And magically, when you get to $10 above the target price, the questioning will stop. It's not that bankers are bad people. The process is broken. The deal maker is the deal analyst. Asking a banker whether a deal makes sense is like asking a plastic surgeon whether there's something wrong with your face. What kind of answer do you think you're going to get? You're perfect already? No, then there's nothing to do. Your nose looks a little long, your lips look a little thin. So basically, that's my job as a plastic surgeon. Bias. Second misconception, if I do a good valuation, I'm going to get the right answer. When does that process get started? probably in kindergarten, first grade. Teacher puts a problem in front of you. My wife teaches first grade. 2 plus 3. You get 5. Congratulations. You got the right answer. You get any other answer. Count your fingers again, because you're probably counting on your fingers. Get it right. Because you got the wrong answer. You must have done something wrong. And this process gets fed into all, and God help you if you end up in a quantitative discipline, engineering, math, because then you get more reinforcement. If you do things right, you get the right answer. If you got the wrong answer, you must have done something wrong. My MBA class this morning asked people, the evaluation class, I asked about their backgrounds. A lot of recovering engineers in that room. So about half my class is quant people, recovering engineers, mathematicians, scientists. The other half is, story people. And I know exactly what's going to happen midway through the semester. Many of the people in that number crunching side, and you can probably self-select in this class as well, which side you're in, will show up in my office with the valuation done, put it on my desk, and I'm done with my valuation. Can you take a look and tell me whether I got the right answer? And I'll predict if you did that, I'll tell you exactly what's going to happen. I'm going to push the valuation across the desk back to you and say, I don't know what the right answer is. And your faith in the system is going to crack. So you're teaching this class, you don't know the right value of every company. If I knew the right value for every company, why would I be teaching this class? I'd own my own island in Hawaii with a castle on top of it, right? But you can see the group splinter when I say that, because half the people can't handle the fact that there is no right answer. You know what happens to them? They become fixed income people. I let them go. It's a nice, healthy recognition, because with the bond, it's all given, right? Coupon, maturity, you might have to worry about default risk, but it's so easy to live with. Not of this growth and AI and all that stuff. You don't care. And that's healthy. You've left the space. The other half says, this is kind of neat. You don't know what the right answer is. I can never, ever convincingly be wrong. Think about that. It's one of the great things about equities. You don't know the right answer is. I can't prove that you're wrong, no matter how outlandish your number is. I like that. But for some people, the psychological barrier of not knowing what the right answer is tough. And you will find this when you value the company. Say, how do I know I'm right? And the more of a number cruncher you are, the more that's going to stress you out. And all I can say is just let it go. Right? Because you can never check your answer, and you got to be okay with it. And the add-on to this proposition is the more uncertainty you feel about your answer, the greater the payoff to doing valuation. About 5 years ago, when I was teaching this class, 2019, there was a week in March where 2 companies went public in the same week. And I'm sure you've heard of both companies. The first company was a company called Lyft. Lyft was the first ride-sharing company to go public. It predated Uber. So you guys are going to value Lyft. Later in the week, a second company went public whose name also started with L, Levi Strauss. Levi Strauss didn't go public till 2019. Levi Strauss has been around 150 years. Used to be public in the last century, went private, but was going back public. So you guys are going to value Levi Strauss. You go to work, you value. Which of these 2 companies, if you define precision as your measure of quality, which of these 2 companies are going to be able to value more precisely? And what is it about Levi Strauss that makes it easier to value? Go ahead. But even money, do you know how Levi Strauss makes money, right? If you're confused, point your back towards a mirror, and if you're wearing jeans, there's probably a 501 in the back. It's made money on jeans. It's a business model that we can see. We know its long history. We know a great deal about the company. It's easy to value. Conversely, Lyft is a business where nobody's figured out how to make money. Terrible business, but lots of potential. It's going to be difficult to value, not because you're not using the right tools or you're not coming with the right cost of capital. It's a lot more uncertainty. So if I measure valuation quality based on precision, Levi Strauss is going to win hands down. But which of these 2 companies do you think the payoff to doing valuation is greater? Why was Levi Strauss easy to value? Because you had a lot of history, you knew the business. You think you're special? Everybody has exactly the same information, right? It is easy to value for, in fact, you probably don't even need people to value. ChatGPT could value Levi Strauss and do about as good a job as you can. Lyft, on the other hand, you know what people do? They give up. You'd be surprised how many VCs I run into who've never valued a company, ever. They price companies, but they can't value a company. They can price per user, price per subscriber. And you ask them why, they say there's too much uncertainty. And I don't get that. When you value a company in the face of uncertainty, you have an advantage because most people are not even trying. Now is the time to value Nvidia, not 6 weeks from now when things have settled in. So if you ask me for advice on what company to value, I'm going to brush you off, but then I'm going to tell you to go where it's darkest. Find a nice Ukrainian mining company to value. Incidentally, there are no nice Ukrainian mining companies. But my point is, go where it's most uncertain. Value a Russian company. Lots of uncertainty coming in every possible direction, because I will wager there isn't a single investor in the world who's actually trying to value Russian companies right now. They're playing the pricing game, but they've given up. Go where it's darkest, where there's most uncertainty. Third misconception about valuation: if I make my model bigger, it's going to get better. We give away how old I am. You can check out my, everybody knows how old you are. You can check when you were born in Wikipedia. No point hiding it. But I'll tell you a little bit about what I used to value my first company. 1981. I wanted to value a company. I had to write to the company with a fountain pen. Now, to the investment relations officer, can you please send me an annual report? I sent it snail mail. And to give the company credit, 2 weeks later, in the mail, I get an annual report. I try to explain this to my kids, and they look at me like I have two heads. They say, why don't you just go online? 1981, there was no online to go into. You don't remember a world where that was true. That was the case. So I get the annual report, and I sit down with my tools in front of me, and here's what I had. In front of me, I had a ledger sheet. You know what a ledger sheet looks like? It's just a blank sheet of paper with lines drawn. And that was a great innovation for me because I always got the lines crooked. The lines came drawn. But it's an empty sheet. There's a calculator to my side, not a slide rule. I'm not that old. And a pencil. I learned very early in my valuation life, don't use a pen. That's what I use to value a company. Today, if you sit down to value a company, you have data, more. This week, when I want to value Nvidia, I'm going to go on Capital IQ, and I sent you that link. Take advantage of it. It's an incredible database. I can download the financials for Nvidia every year through its entire history. It'll take about 1 minute. It'll come into an Excel spreadsheet. Nice. I've got the entire financials. If I want to spend an extra 2 minutes, I can download the financials for every semiconductor company while I'm there. In 3 minutes, I can collect data, which would have taken me months, if at all, to collect in 1981. And today, of course, I don't use a calculator and a paper. I use an Excel spreadsheet. It's a tool. It saves me a lot of trouble. But here's the downside, though. When I did my valuation on a ledger sheet, you know how many line items there were in the valuation? As few as I could get away with. Do you see why? Because every single cell had to be hand calculated and written in. Adding an extra line item, you had to think long and hard about, do I want to break that into more detail? And you did it if you had to. But if you didn't have to, you said, why am I going to compute 30 more cells? Today, you're in Excel. You want to add a line item. It takes you this long. You write a macro. You have 50 more line items. And you carry this logical limit. You have banking spreadsheet valuations. I don't know how many of you worked at a bank in the summer. But a banking valuation spreadsheet is like a hydra. The monster, not the, It's like 15 worksheets connected together, hundreds of line items. And the selling pitch is more detail creates better estimates of value. I don't think so. Two things happen with these gigantic spreadsheets. The first is, you're not sure who's running who. Are you running the model, or is the model running you? There's a time in the day where that power shifts around 10 o'clock at night. The model starts asking you to do things. Go get me a cup of coffee. I don't want the model to get mad at me. You'd be amazed at how many valuation reports I read where the analyst says the model valued the company at. You know what the analyst is saying? Don't blame me. I fed numbers into this gigantic spreadsheet. Something happened in the middle. I have no idea. There are all these worksheets that I connected. The value popped out on the other side. I'm going to give you an Excel spreadsheet. I don't want to make this a class where you build Excel spreadsheets from scratch. That's a different class. That's an Excel class you can take. I'm going to give you an Excel spreadsheet. It's not rocket science. It's a spreadsheet which basically values any company. You're free to use that spreadsheet. In fact, I would encourage you to use the spreadsheet because it saves you the model building exercise. On one condition. The condition is when you turn in your final report, here are the words I don't want to see. That the Modern model valued the no. Don't try to pass the buck on me for why you're buying or selling a stock. Make the model your own. Adapt it, modify it. I've never written a macro in my life. There are no protected cells. It's going to be easy to change and modify if you want to. Make it your spreadsheet. Because you can mangle some really simple assets using complex models. Keep it simple. I've never valued a company with more than 12 line items. I don't add detail unless I feel I can bring something to that detail. So with that in mind, let's talk a little bit about the biggest challenge of valuation, because basically I've talked about three things, right? Bias, I've talked about uncertainty, and I've talked about complexity. We live in a world where you're going to have jobs, you have to value companies, and whether you like it or not, if you have a job, somebody's paying you, there is always going to be bias in the process. You're going to face uncertainty. Do we face more uncertainty now than 40 years ago? I think so. I think globalization has basically created this world where we're all connected at the hip. So China goes through a crisis, you're going to feel the pain in your story, in your valuation. More complexity, more uncertainty. And we are creating a world where it's easier to build these complex models. And what I call the Bermuda Triangle of valuation. You're at the mythology of the Bermuda Triangle, right? It's supposedly this triangle in the Atlantic where ships and planes disappear into. The Bermuda Triangle of valuation is where good sense disappears. When people talk about what's going wrong with the valuation, they think it's some technical detail, that they're not getting the cost of capital right, the cash flows are wrong. Most valuations go wrong because of one of these three factors, not because of the technical details in how you do things. So I'm going to set the table for the rest of the class. There are only three ways you can put a number on a company. The first is an intrinsic valuation. What do you try to do in intrinsic valuation? You value an asset or a business based on its cash flows, growth, and risk. Second is pricing. We attach a number to an asset based on what other people are paying. Imagine playing SeatGeek with stocks. Have you ever used SeatGeek? You want to buy a ticket in a section of Yankee Stadium? How do you decide how much to pay? You go to SeatGeek, you look at what people are charging for prices. They actually help you out, right? Amazing deal, great deal, good deal. If you ever use SeatGeek, you should. It's a great exercise in pricing, because the way they make that judgment is by comparing the prices across different deals. It's pricing. And the third approach is there are some businesses where there's optionality, where there is, we talked a little bit about this in the first class, a pharmaceutical company working on a drug that's working its way through the pipeline, an oil company with undeveloped oil reserves that are expensive today. There is an optionality where if things happen, these companies could become valuable. That's the real options component. People will tell you there are hundreds of ways to value companies. That's not true. There are only three approaches. There are a lot of sub-slices within these, but ultimately it's got to fall into one of those three buckets. So let's start with what all of these approaches implicitly assume about markets. Lisa was in my office just before, and I'd encourage you guys to drop by and just say hi. And Lisa, do you remember the question you asked me about markets? What is the question you asked? Are markets perfect? It's the question she asked. And if I'd said yes to the question, this class would be kind of pointless, right? Because what's the best estimate of Nvidia's value? Just go look up the price, right? In an efficient market, this whole process would be pointless because the market price is the best estimate of value. And that's actually not a bad null hypothesis. The market is doing a reasonably good job. But the minute you use an approach, whether it's pricing or intrinsic valuation to tell me that a stock is cheap, you're implicitly also saying what? That the market makes mistakes That's the easy part because everybody will agree. And that you can find those mistakes. You can have the first and not the second, right? So as I describe these approaches, I'm going to talk about what you must think about markets or believe about markets for you to do intrinsic valuation as opposed to pricing. So why would I use one of it? It depends on where you think market mistakes happen and how they get corrected. So let's start with intrinsic valuation, or the version of it that you most often see in practice, which is a discounted cash flow valuation. It's not magic. The value of an asset is the present value of the expected cash flows in the asset. Does that sound familiar? Probably in the very first finance class, you heard this somewhere along the way, right? That's basically what discounted cash flow valuations. Philosophically, what are you trying to do? You're trying to estimate the intrinsic value of an asset, a business, a cash. And already you can start to see a debate brewing. Is there a thing called intrinsic value? Can you prove there's one? I can't. That's why I call it faith. It's like a little bit like the search for the Holy Grail. How long have people been searching for the Holy Grail? I think thousands of, I think Indiana Jones came really close in this first movie. But nobody's found it, but we keep looking and looking. That's what we try to do in intrinsic valuation. We keep the faith. But it does require faith. You're trying to estimate intrinsic value. And if you look at what goes into a discounted cash flow model, no matter how complicated and complex you try to make it, you see a life for the asset, expected cash flows over that life, and a discount rate that reflects the risk in the cash flows. There's no rocket science. Nobody's going to win a Nobel Prize for saying, I found discounted cash flow valuation. It's always been there. But if you think about the kinds of market mistakes you need to make money with discounted cash flow valuation, first, you have to assume markets make mistakes. Second, you got to assume that your discounted cash flow model is allowing you to find those mistakes. And that's a dangerous assumption, because what's a track record of most people who claim to find market mistakes? Or let me rephrase the question. Remind me again what the average active fund manager beats the market by every year. Minus 1.5%. It's the strangest profession on the face of the earth. It's like having a plumbing business called Floods or Us. And here's what you do. I have a leak in my house. I call you and you leave a flood. And you then send me a bill. How long would you stay in business? Not very long. But that's what active money managers do, right? You can effortlessly beat them by 1.5% by buying an index fund. They say, trust me, send me your money. I'll take a management fee and I will deliver 1.5% less than the index fund. You say, okay, let me send it out right away. Yeah. But let's say you're special. You can find that market mistake. Let's get the mistake a name. Nvidia after today. You value the company at 130, the stock's at 110, whatever it turns out to be. It's a third assumption you need to make money. We talked about this. The price has to adjust to value. So when you do intrinsic valuation, you assume markets make mistakes, that you can find those mistakes, and that the market corrects its mistakes. So how do you make the market correct its mistakes? So let's say you buy Nvidia. What do? Go on Facebook and write, Nvidia is cheap, Nvidia is cheap, Nvidia is cheap, Nvidia is cheap. Tweet out, Nvidia is cheap, buy it now. You can do everything you want, but the odds are that it's just going to go into the noise and nobody cares. This is, I think, what makes investing frustrating. You can be right and go bankrupt being right. Your neighbor can pick stocks based on astrological signs and end up making millions of dollars. Why did you buy Nvidia? Because the stars had aligned. Where's the cash flow? No, stars had aligned. That's all that matters, right? It's not fair, but it is what it is. So I'm going to leave you with the final page. When you think about why we do intrinsic valuation, your biggest advantage is it forces you to think about the business, right? You cannot value Nvidia without understanding the business. There's an old Buffett saying that he doesn't buy shares in a company, that he buys pieces of business. If you subscribe to that, intrinsic valuation is for you. Second, it is going to make you understand that you're buying a set of cash flows, even if everybody else. So when you think about the reason why people do intrinsic valuation, it's because of these pluses. The minus, of course, is it does require a lot of inputs. It does also mean that if the market correction doesn't happen, you're stuck with the stock that never delivers money. And if your job requires you to be fully invested in stocks, which is what a mutual fund job is, what if you do intrinsic valuation? Every stock you value turns out to be overvalued. You won't last very long as a fund manager. So next session, when we talk about we will start with why people like pricing, right? And why some people might be able to get this correction part under their control. Right? So I will leave you with that. I'll see you on Wednesday.
I think it's relatively low. I don't want to tell you my address tonight. When you look at this time, have a relatively not a little bit.
Right after class on Wednesday.
Thank you so much.